Right now, Wall Street is trapped in a massive echo chamber. They are assigning astronomical multiples to semiconductor designers and AI software companies, completely ignoring the absolute physical limit of this technology, the power grid. Software growth is a bubble if the physical grid cannot sustain it. Today we are looking at GE Vernova, ticker symbol GEV. Since its spin-off, this company has established itself as a pure-play global energy infrastructure monopoly. They are the ultimate gatekeeper of the AI revolution. Because to deploy 1 gigawatt of AI computational power, hyperscalers must pay a physical toll in generation and grid infrastructure. Welcome to StockScope. Let's break down the ultimate backdoor AI trade. To understand why GE Vernova commands pricing power, you have to understand their unassailable footprint. This is not a startup you can replicate in a garage. This is the backbone of global macroeconomic stability. Today, a staggering 25% of the entire world's electricity is generated using GE Vernova technology. If you exclude China, that number jumps to 33%. And domestically, 50% of all electricity flowing through the United States runs on GEV infrastructure. This is a global monopoly operating at a scale that is mathematically impossible for new competitors to disrupt. That global dominance translates directly into the metric institutional investors care about most: remaining performance obligation, or backlog. In fiscal year 2025, GEV's total backlog surged 26% year-over-year to a jaw-dropping $150.2 billion. Let that sink in. That is $150 billion of legally contracted, locked-in revenue streams spanning the next decade. While tech hardware companies worry about quarter-to-quarter sales fluctuations, GE Vernova operates with total multi-year visibility, rendering them virtually immune to short-term economic recessions. And that backlog is rapidly converting into a fortress of cash. Looking at the fiscal year 25 results, the company generated $38.1 billion in revenue and printed $3.7 billion in free cash flow. Adjusted EBITDA surged 57% to $3.2 billion. But here is the critical signal for the smart money. Management knows they are swimming in cash, so they are aggressively rewarding shareholders. They recently doubled their annual dividend to $2 per share, and they expanded their share repurchase authorization to a massive $10 billion. They are effectively using their cash flow to shrink the float and compound EPS. This cash flow is protected by an oligopoly shared only with a few global players like Siemens and Mitsubishi. GEV commands an installed base of 7,000 gas turbines and 59,000 wind turbines globally. But the real institutional alpha is the transition in their business model. Historically, selling heavy equipment yielded lower margins. Today, GEV boasts an $86 billion services backlog. They are locking their massive installed base into decades of high-margin recurring maintenance contracts. Beyond just generating power, you have to move it. This brings us to their crown jewel, the electrification segment. Over the last 4 years, the equipment backlog in this division has quadrupled to $34.6 billion. Why? Because you cannot connect a massive AI data center or a new solar farm to the main grid without alternating current substations, switchgears, and massive transformers. GEV produces the critical physical hardware and the grid management software required to keep the lights on. And this brings us to the core catalyst. The International Energy Agency projects data center power demand will triple by 2035. Tech giants are realizing they cannot build their AI utopias without raw electricity. In Q4 of 2025 alone, GEV reported a massive surge in direct orders straight from tech hyperscalers. Amazon, Microsoft, and Google are bypassing traditional utility timelines and going directly to GE Vernova to secure the gas turbines and grid infrastructure they desperately need. To remain objective, we must address the bear case and the operational risks currently priced into the stock. First, there is the offshore wind bleed. The wind segment is a cash burner, reporting an EBITDA loss of $598 million in FY25 due to legacy contracts and regulatory delays. Second, supply chain and global tariffs hit the company for $250 million in 2025. And finally, the valuation premium. The stock has run up significantly since the spinoff, meaning the current multiple leaves management with absolutely zero room for execution errors. But the bull case, the institutional reality, dwarfs these short-term headwinds. First, the AI grid supercycle guarantees a structural, multi-decade CapEx investment cycle by utility companies. Second, That $150 billion backlog provides a bulletproof financial cushion while management fixes the win segment. And third, aggressive margin expansion. Adjusted EBITDA margins expanded 260 basis points last year, and that $10 billion buyback will continuously support the stock price. This dynamic creates a massive blind spot in the market. We are seeing a severe multiple arbitrage. The market is perfectly happy assigning 50x multiples to semiconductor designers, but it is underestimating the physical infrastructure providers that make those chips function. Institutions are quietly accumulating GE Vernova as the ultimate backdoor AI trade, gaining exposure to the AI supercycle without the hyperinflated tech valuations. Now, let's look at the technical chart to time our execution. The price action reflects massive institutional accumulation, but we need to be strategic. The stock is currently trading within a very clear, defined upper trend channel. Right now, we are hitting the upper limit of that trendline resistance. Because the stock is technically overextended at this upper boundary, we can actively expect a healthy technical correction over the next 1 to 2 months. Do not chase the breakout here. Instead, let the algorithmic traders take profits, let the chart cool off, and use the upcoming correction to search for optimal, lower-risk entry points near the bottom of the channel. So what is the stock scope verdict? We are rating GE Vernova a moderate accumulation on a margin of safety. The $150 billion backlog and the hyperscaler energy demand make this a non-negotiable, multi-year hold for infrastructure portfolios. However, given our technical read at the top of the trendline, patience is key. Wait for the upcoming technical correction to build your position. Respect the grid, trade the infrastructure, and make sure you subscribe to StockScope for our next institutional deep dive.